Credit report errors are more common than you think. Millions of consumers discover mistakes on their reports each year. These errors can have serious consequences. They affect your ability to get loans, rent an apartment, or even secure a job. Credit bureaus, also known as credit reporting agencies, play a crucial role in the financial system. They collect data on your borrowing and repayment history. This data is used to create your credit report. Lenders use your credit report to assess your creditworthiness. There are three major credit bureaus: Equifax, Experian, and TransUnion. Each bureau maintains its own credit report on you. It's important to remember that your credit reports from each bureau may not be identical. Disputing errors on your credit report should be straightforward. However, the process can be complex and confusing. Credit bureaus often make it difficult for consumers to correct mistakes. You may have to navigate automated phone systems and online portals. The credit bureaus are required to investigate disputes within 30 days. However, investigations can drag on for months. In some cases, errors remain on credit reports even after they have been disputed. Credit report errors can take many forms. Some of the most common errors include incorrect personal information. This includes mistakes in your name, address, or social security number. Inaccurate account information. This includes accounts that don't belong to you, incorrect balances, or late payments that were actually made on time. Duplicate accounts. This occurs when the same account is listed multiple times on your credit report. Fraudulent activity. This includes accounts that were opened in your name without your knowledge or authorization. These errors can have a significant impact on your credit score. Your credit score is a numerical representation of your creditworthiness. A higher score indicates lower risk for lenders. Section 5. The consequences of inaccurate credit reports. In today's financial landscape, your credit report plays a pivotal role in determining your financial health and opportunities. Errors on your credit report can have far-reaching consequences. These inaccuracies can stem from simple clerical errors, identity theft, or outdated information that hasn't been corrected. A lower credit score can result in higher interest rates on loans. This means that over the life of a loan, you could end up paying thousands of dollars more than someone with a higher credit score. Lenders view borrowers with lower credit scores as riskier, and as a result, they charge higher interest rates to offset this risk. Denied credit applications are another common consequence. A low credit score can lead to rejections for credit cards, mortgages, and auto loans. This can severely limit your ability to make significant purchases or investments, affecting your overall financial stability. Increased insurance premiums. Some insurance companies use credit-based insurance scores to determine premiums, so a lower credit score may result in higher insurance costs. This can add an additional financial burden, making it harder to manage your monthly expenses. Difficulty renting an apartment. Landlords often check credit reports to screen potential tenants, and a poor credit history could make it harder to find housing. This can limit your options and force you into less desirable living situations. It's crucial to understand that even small errors on your credit report can have significant consequences. Regularly reviewing your credit report and addressing any inaccuracies promptly can help you avoid these pitfalls and maintain a healthier financial profile. Section 6. Mixed-up files, a case of mistaken identity. One particularly concerning type of error is mixed-up files. This occurs when your credit report is mixed up with someone else's, often someone with a similar name or social security number. This can lead to a situation where you are wrongly penalized for someone else's poor credit history. If you suspect that your credit report contains information that belongs to someone else, it is essential to contact the credit bureaus immediately and initiate a dispute. Section 7. The importance of regular credit report monitoring. Given the prevalence of credit report errors, it is essential to monitor your credit reports regularly. You are entitled to one free credit report from each of the 3 major credit bureaus every 12 months. You can request your free reports online at annualcreditreport.com, the only authorized website for free credit reports. Regularly reviewing your credit reports allows you to identify and address errors promptly. Section 8. Taking action. How to dispute credit report errors. If you find an error on your credit report, you should dispute it with the credit bureau that issued the report. This can be done online, by phone, or by mail. Gather supporting documentation. When disputing an error, provide as much documentation as possible to support your claim. This may include bank statements, credit card bills, or other relevant documents. Be clear and concise. Clearly state the errors you have found and provide all necessary information to support your dispute. Keep records of all correspondence. Keep copies of all communication with the credit bureaus, including dispute letters, emails, and any responses you receive. By taking these steps, you can improve your chances of getting errors removed from your credit report. Section 9. Protecting your credit tips for a healthy score. Your credit score is a crucial aspect of your financial health, and maintaining it requires consistent effort and attention. Protecting your credit is crucial for financial well-being. A good credit score can open doors to better interest rates, loan approvals, and even job opportunities. Here are some tips to help you maintain a healthy credit score. These strategies are simple yet effective in ensuring your credit remains in good standing. Pay your bills on time. Timely payments are the foundation of a good credit score. Missing payments can significantly impact your score and take time to recover from. Payment history is a significant factor in your credit score. It shows lenders your reliability in repaying debts. Set reminders or utilize autopay to avoid late payments. These tools can help you stay on track and ensure you never miss a due date. Keep your credit utilization low. This means using only a small portion of your available credit. High utilization can signal financial distress to lenders. Credit utilization refers to the amount of credit you are using compared to your total available credit. It's a key component of your credit score. Aim to keep your credit utilization below 30%. This shows that you are managing your credit responsibly. Limit new credit applications. Each time you apply for credit, a hard inquiry is placed on your credit report, which can temporarily lower your score. Too many inquiries in a short period can be a red flag to lenders. Review your credit reports regularly. This helps you stay informed about your credit status and catch any errors or fraudulent activities early. As mentioned earlier, regularly checking your credit reports allows you to identify and address errors quickly. Disputing inaccuracies can prevent them from harming your score. By following these tips, you can help safeguard your credit and protect your financial future. A healthy credit score is a valuable asset that can enhance your financial opportunities and security. Section 10. Know your rights. The Fair Credit Reporting Act. The Fair Credit Reporting Act, or FCRA, is a federal law that protects consumers' rights concerning their credit reports. Enacted in 1970, it ensures the accuracy, fairness, and privacy of the information in the files of consumer reporting agencies. The FCRA gives you the right to know what's in your credit report. You have the right to access your credit report from each of the 3 major credit bureaus. These bureaus include Equifax, Experian, and TransUnion. You are entitled to one free report from each bureau every 12 months through annualcreditreport.com. Dispute inaccurate information. If you find errors on your credit report, you have the right to dispute them. The credit bureau must investigate your dispute within 30 days, and if the information is found to be incorrect, it must be corrected or removed. Limit access to your credit information. You can control who has access to your credit report, such as when applying for a loan. Only those with a legitimate need, like creditors, insurers, employers, and landlords, can access your report. Seek damages for violations. If a credit bureau or furnisher of information violates the FCRA, you may be entitled to sue for damages. This includes actual damages, statutory damages, and even punitive damages in cases of willful noncompliance. Understanding your rights under the FCRA is crucial for protecting your credit and financial well-being. By staying informed and vigilant, you can ensure that your credit report remains accurate and that your financial reputation is safeguarded. Section 11. Conclusion. Taking control of your financial future. Credit report errors are a serious problem that can have lasting consequences. By understanding how credit bureaus operate, the common types of errors, and your rights under the FCRA, you can take control of your credit health. Regularly monitoring your credit reports, promptly disputing any inaccuracies, and practicing good credit habits are essential steps in safeguarding your financial future. Remember, your credit score is a reflection of your financial responsibility. By taking proactive measures to protect it, you can open doors to greater financial opportunities and security.